Yesterday's EIA weekly report on inventory said crude oil storage is up yet again. Natural gas inventories reports from EIA will be released later this morning. Joining us now for analysis is our good friend Elliott Gue, editor of the Energy Letter and the Energy Strategist. Elliott, good morning. Thanks for being with us.
Thanks for having me.
Let's dive right in. What are you expecting from the EIA today? Yet another build upon weeks and, in fact, months of builds for natural gas?
Sure. I'm looking for about a 61 billion cubic foot build, which is about average for this time of year. Typically, over the summer months, you do see inventories continue to build. We are seeing sort of the heat of the summer cooling season. So that's moderated the build from what we saw, some weeks back. But still, it looks likely that natural gas storage is going to reach its physical maximum level by the end of the injection season.
The supply news couldn't dampen crude oil prices yesterday. I mentioned they were up just a little bit. What about natural gas? It had a 10% jump or thereabout on Monday. And unlike the last several times that happened over the spring and summer, do you think that could sustain for the weeks to come?
I do think it's sustainable. I'm not sure whether this particular run is gonna hold up, but I do think that between now and the end of the year, you will see natural gas prices generally rise. Probably by the end of this year, you could see gas trading around $5. Maybe even a little bit higher than that. Eventually, say a year from now, I would expect gas to be at a more normal level of sort of $6 to $7 for a million BTUs. It's really been the inventory situation is just extremely well known. We've known for months, the producers have been saying for months that inventories were going to hit that maximum level. Obviously, they're extremely glutted. But in the markets, they often say sort of a known fundamental is a useless fundamental. If everybody knows something, then it's probably already factored into the price. And I think that's what you've seen with natural gas.
We had a report earlier this week that Chesapeake, Anadarko, and one of the big majors weighed in saying they were ramping up production in the Marcellus shale. Why that shale, and is that indicative of what we'll see across many of the shale plays, if not all of them in the U.S.?
Well, I think there's a couple of reasons Marcellus is hot right now. One is the economics are pretty good there. And the other thing you have to look at is the basis differentials. In other words, gas trades at different prices in different parts of the country. Marcellus is located in the east, near the major gas-consuming markets. So natural gas prices in that area tend to be a little higher than they might be in, say, the Rocky Mountains or even the Henry Hub, which is the official delivery point for NYMEX natural gas. So that's one reason. The other reason, for example, in Chesapeake's case, is that they have partnered with Statoil on a lot of those on a lot of their plays in the Marcellus. So that means that Statoil is footing part of the bill. And in fact, that they've partnered with major producers on a lot of their finds, and that's helping them really lower their cost and boost their profit margin. So they're not having to pay up front for all those expensive wells. They're getting a little help from their partner.
I know, Elliott, part of your job description is haunting the conference calls
right.
from various players. What are you hearing this week? It sounds like there's some substantial news coming out from some of the big players in natural gas.
Yeah, there are a number of things out there. One of the main thing they're all saying in terms of inventories and natural gas prices is that we are going to hit that physical maximum. You heard a number of the producers bump up their production targets for this year, which comes as a surprise to a lot of people. Why would they be bumping up their targets in the face of such a glut of inventory? The reason is they know that the storage is going to fill up, so they might as well produce the gas, sell it, and get some revenue in. Rather than hold back production and let other producers fill up the storage. So I think that's pretty much a foregone conclusion at this point. There are a few comments out there. Chesapeake was very interesting, as usual, on their call, predicting natural gas production in the United States to be down sort of as much as 3 billion cubic feet year over year by the end of this year, and as much as 5 billion cubic feet year over year by next spring.
Is that a result of potentially reaching capacity in storage?
It's really a result of the massive decline we've seen in the rig count. First we saw the vertical rig count, basically the older rigs in the conventional plays, start declining about a year ago in late August of last year. Then a few months later, in late October, we saw the horizontal rig count, which is a good proxy for activity in shale plays. That began to decline. We are also seeing the first signs from the EIA numbers, which are released with a 2-month lag, of actual declines in U.S. natural gas production. Now, obviously, demand is also way off, particularly industrial demand. But if you look at the numbers, just sort of a back-of-the-envelope calculation, if demand recovers a little bit with the economy, And those targets that Chesapeake was talking about are reached in the sense that we do see that level of year-over-year decline in production. Over the next year, that could be expected to balance the natural gas market.
And that leads into my final question, Elliott, which is positive manufacturing news in the U.S. this week. Similar situation in China in terms of it ramping up again. How much is natural gas now tied not just to economic news, but to manufacturing regaining its footing and churning up production again?
I actually think that's a huge thing to watch. If you look at the actual numbers, really natural gas used in electric power plants has actually been up a little bit because what you're seeing is a lot of companies, utilities that can choose coal or natural gas are just going ahead and using natural gas. There's some fuel switching going on. Natural gas used for wintertime heating last winter was actually pretty strong because it was a cold winter. The real area that's been consistently weak in terms of demand is industrial demand. And that's going to be your manufacturing, your chemical uses for natural gas, and that's extremely tied to the economy. That's probably the most tied to the economy. The key number that I watch on that is the industrial production figures. If you look at industrial demand for gas and industrial production numbers released from the government, they track each other very, very closely. We've seen a massive decline in industrial production. However, that rate of decline has been slowing for months now. And it's probably, I believe, going to start to turn positive here in the next few months. If that's right, we should see the industrial demand for natural gas stabilize and then begin to recover. And it's going to be a combination of the demand and the supply drivers that's going to send natural gas higher. You're going to see demand begin to come back a little bit. At the same time, you're going to see supply ramping down because of decisions that were made late last year and earlier this year in terms of rig count.
Right. All right. Elliott Gue is editor of the Energy Letter and the Energy Strategist as well. Always a pleasure to have you with us, Elliott. Same time next week.
Sounds good.
All right.
Nice
Thanks
to be
so
back.
much.